Good day, Integrity Academy students. I trust everyone is good. So today we will be discussing all how to calculate the taxation of lump sum benefits, which is in unit 13030. These slides, the first few slides, I'm not going to go through them. Please kindly go through them on your own, but I just want to stress out that plagiarism is not allowed. That is copying from slides with word by word. Please try as much as possible when taking the slides information to put it in your own words when you are answering the questions. Yes, these ones I'm not going to go through. I'm just going straight to the point on how to calculate and comment on the taxation of lump sum benefits from retirement funds. So, assessment criteria 1, that is relevant definitions are defined and applied as stated in current tax legislation. Activity 1, provide brief definition for a pension fund, provident fund, retirement annuity fund, and preservation funds. The definitions of pension fund, pension preservation fund, and retirement annuity fund require that the rules of the fund must provide that not more than 1/5 of the total value of the retirement interest may be committed for a single payment, except where 2/3 of the total value does not exceed 165,000. This simply means that if the total value of the fund does not exceed 247,500 on the retirement of the member, the total benefit may be taken in the form of a lump sum. In the event of the death of the member, the definition allows for the total retirement interest in the fund to be taken in the form of a lump sum. The FSCA registers pension and provident funds as pension fund organizations as defined in the Act. They are, however, approved by SAS as pension or provident funds, or pension preservation or provident preservation funds, or retirement annuity funds as per the requirements set out in the respective definitions in the Income Tax Act. The Income Tax Act also governs the way fund contributions and fund benefits are paid and taxed. For fund members and employers to take advantage of the tax deductions available in respect of contributions made in a particular year of assessment, a retirement fund, irrespective of the type of fund, is required not only to be registered by the FSCA but also to be approved by SAS for tax purposes. The different types of retirement funds can be divided into two broad categories, namely occupational funds and non-occupational or individual funds. Occupational retirement funds contribute to the welfare and efficiency of an organization and its employees in several ways. Not only is the security and stability of employment increased if the staff are assured of a pension on reaching retirement age, that is, if they remain employed until retirement. But from the employer's viewpoint, the overall efficiency of the organization is likely to be increased if there is an orderly retirement of senior employees at a reasonable age, which will allow for employment and promotional opportunities for younger employees. In addition, a fund which provides ancillary benefits such as life and disability cover will relieve the employer of the moral responsibility to provide maintenance to the surviving spouse and children of an employee who dies whilst in the service of the employer, or to the employee themselves should they become incapacitated whilst employed. Under a properly constituted pension or provident fund, the fund costs are spread in the form of regular contributions. The employee receives a tax concession in respect of contributions made, as does the employer, and the ultimate cost to the employer will be less than would be the case if the employer were to pay the benefits. The employer will not have to face the disbursement of pension benefits out of revenue at irregular intervals. And in the case of defined contribution fund, the liability will be limited to the payment of regular contributions on a fixed scale, which will facilitate budgetary planning. In much the same way, employees can plan their affairs with the knowledge that provision has been made for their old age. Occupational retirement funds refer to pension funds and provident funds. The definition of pension fund and provident fund in the Income Tax Act requires that an employment relationship exists between the employer and employee or member of the pension and or provident fund, and it must be a condition of employment for employees or a category of employees who are or become eligible for fund membership as defined in the fund rules to join the fund and remain members until termination of their employment or until the fund ceases to exist. Individual funds are for those individuals who do not belong to an occupational fund. And for members of occupational funds who wish to make additional retirement savings outside of an occupational fund or who wish to preserve their pension and or provident fund benefits in a retirement annuity fund or preservation fund upon the termination of employment. I hope so far we are all clear. But if you still need clarity, please contact us. Please see the full definition of pension funds, provident funds, retirement annuities, and preservation funds in your textbooks or do research on Google. The effect of the taxation of lump sum withdrawal benefit is best illustrated by way of a few examples. So let's have a look at example 1 here. If a member withdraws from a fund after 1st March 2019, that is between 1st March 2019 and 29 February 2020, and receives a lump sum withdrawal benefit of 325,000, the first 25,000 will be taxed at 0% and the balance will be taxed at 18%, resulting in total tax payable of 54,000. Let's look at case study 1. Calculate the tax payable in the following scenario if the same member withdraws from another fund a couple of years later and receives a lump sum withdrawal benefit of 1,250,000, and tax will be calculated by adding the previously accrued lump sum of 250,000 withdrawn 1st of February 2018 and the current 1,250,000 lump sum, and then calculate the tax on the combined amount of 1,500,000. 1. Current taxable lump sum benefit will be 1,250,000. We add to that all retirement lump sum benefits received on or after 1st of October 2007, excluding current lump sum, of which in our case we do not have any amount. Then we add also to that all withdrawal lump sum benefits received on or after 1st of March 2009, excluding current withdrawals. In our case, we have that withdrawal from the fund on 1st of February 2018 of 250,000, bringing our total aggregate of lump sums received to 1,500,000. And then 2, we subtract deductions according to paragraph 5 and 6 of the second schedule of Income Tax Act. And these deductions are own non-deductible contributions, which we don't have in our case, and transfer to pension, provident or preserver or retirement annuity, and section 37D for divorce, which we don't have, an amount transferred to another fund that was taxable, we don't have in our example, taxed and claimed benefits transferred to preserver, we also don't have any figure for it, and transfer to fund from GAP or parastatal, if formula C applies, less A in formula, we don't have that amount. Then the B, total of all allowable deductions, we don't have any. So the current taxable lump sum benefit, which is A minus B, will still be 1,500,000. Number 3, we apply taxable we apply tax table applicable to current taxable lump sum benefits. The tax tables, it is always given each and every year. There is a new tax table that is provided. So there is our tax table there. And then number 3, we do the calculations. Since 1,500,000, it exceeds 1,089,000 and 1 and above. You see, according to the tax table, it says that 223,740 plus 36% of taxable income exceeding 1,089,000. Therefore, 2,23740 plus 36% of the amount exceeding 1,089,000, which is 411,000. Then that 411,000 we multiplied by 36%, which is 147,960. And remember that we are going to add that 147,960 to the 223,740, bringing the total to 371,700. Sometimes the students find this calculation complex, but please do consult us if you still need help regarding the calculation. And number 4, reduction of tax aggregate, that is we add together and then apply the tax table. That is we add all our retirement lump sum benefits received on or after 1st October 2007, which you don't have, and then we add withdrawal lump sum benefits received on or after 1st of March 2009, which we have that withdrawal from the fund on 1st of February 2018 of 250,000, bringing our aggregate of all lump sums received prior to a current taxable lump sum benefits to 250,000. And then step number 5, we apply the tax table applicable to a current taxable lump sum benefits, and there is the taxable income from lump sum withdrawal benefits. And then we do the calculation, which is 27,500 plus 18% of taxable income exceeding 27,500, which is 22,500. Then that 22,500 we multiplied by 18%, bringing the total to 40,050. And then number 6, we determine the tax payable on the current lump sum benefits. And then we take the value in block 3, which is 371,700, less the value in block 5, which is 40,050, bringing the total of 331,650 as our tax payable on current lump sum benefits. The tax on the 1,500,000 will be 223,740 plus 36,000 on the amount above 1,089,000, which amounts to 411,000. Since we made use of the new table, the amount of tax on the previous lump sum must also be calculated using the same table. The tax on the previous lump sum of 250 will be calculated at 18% on the amount above 27,500, which amounts to 40,050. That's a hypothetical tax calculation. To calculate the tax payable on the 1,500,000, the tax calculated in respect of the previously accrued lump sum is deducted from the tax on the total lump sum. Thus, tax payable is 371,700 less 40,050, bringing the total to 331,650. That was a brief summary. So case study 2, calculate the tax payable in the following scenario. If the same member retires a couple of years later with an amount of 1,955,000 and elects to take 550,000 as a cash lump sum and transfer the balance to a provident preserver fund, his taxable amount will be calculated by using the following retirement lump sum tax table. The retirement lump sum withdrawal benefits table. There it is. Please take note that the taxable income from a retirement fund lump sum benefit, and is lump sum from a pension, provident, or retirement annuity fund on retirement, is determined after deducting a lifetime exemption of 550,000. Remember that there is that lifetime exemption of 550,000. So to calculate the tax payable on the lump sum retirement benefit, all the previously accrued lump sum benefit must be accumulated. That is case study 1, 250 and 1,250,000 as benefits previously received, plus the current lump sum of 1,955,000 lump sum retirement benefits taken now, considering that you will only withdraw 550 now. Remember to include the full 1,955,000 as the current lump sum in block 1 and use the calculation grid to provide for the calculation of the deduction under paragraph 5 and 6, second schedule of the Income Tax Act. So Our number one there, our current taxable lump sum benefits will be 1,955,000. So we add to that all retirement lump sum benefits received on or after 1st of October 2007, of which in our scenario we don't have any. And then we are also going to add all withdrawal lump sum benefits received on or after 1st March 2009, which will be the withdrawal from the fund on 1st March 2018 of 250,000, withdrawal from the fund after 1st March 2019 of 1,250,000. So our A, which is total aggregate of all lump sums received, which will comprise of that our current taxable lump sum of 1,955,000, 250,000, the withdrawal from the fund, and the withdrawal from the fund again of 1,250,000 will equal to 3,455,000. I am believing that we are still together so far. And then number two, remember we subtract deductions according to paragraph 5 and 6 of the second schedule of Income Tax Act. If you have forgotten about it, please go back again, remind yourself about paragraph 5 and 6 of the second schedule of Income Tax Act. That is the own non-deductible contributions. In our scenario, we don't have transfer to pension, provident, or preserve our retirement annuity, section 37D, divorce. We don't have the amount transferred to another fund that was taxable is 0. We don't have, and tax unclaimed benefits transferred to preserver is 1,405,000. And transfer to funds from gap parastatal, if formula C applies less A in formula, we don't have that amount. So our total of all allowable deductions will be 1,405,000. So our current taxable lump sum benefit will be A minus B, which is 2,050,000. Case study 2. Calculate the tax payable in the following scenario. Case study 1, 250 and 1,000,000 as benefits previously received, plus the current lump sum of 1,955,000 lump sum. Retirement benefits taken now, considering that you will only withdraw 550,000 now. Just reminding you of the example we are busy with. Remember to include the full 1,955,000 as the current lump sum in block 1 and use the calculation grid to provide for the calculation of the deduction under paragraph 5 and 6 second schedule. So number 3, we apply tax table applicable to a current taxable lump sum benefits. That is there below there is our retirement lump sum benefits tax table. So number 3, we do the calculation, which will be 143,550 plus 36%, which is we take 36% of 2,050,000 minus 1,155,000, which is 895,000, and multiplied by 36,000, bringing it to 322,200. Then that 322,200, we add the 143,550 to it, and it totals 465,750. Then number 4, reduction of tax, that is aggregate. We add together and then apply the tax table. We add all retirement lump sum benefits received on or after 1st of October 2007, excluding current lump sum. And then we also add all withdrawal lump sum benefits received on or after 1st of March 2009, excluding current withdrawal. That is the 250 withdrawal from the fund on 1st of March 2009, and then withdrawal from the fund after 1st of March 2009 of 1,250,000. Then the aggregate of all lump sums received prior to a current taxable lump sum benefits would be 1,500,000. And number 5, we apply tax table applicable to a current taxable lump sum benefits. Taxable income from lump sum withdrawal benefits, there is a taxable tax table there below there. So number 5, we do the calculation. That is 223,740 plus 36% of 1,500,000 minus 1,089,000. It is 411,000. We multiply that by 36,000. It brings the total to 147,960. But it doesn't end there. We still have to add the 223,740 to it, which will give us a total of 371,700. And number 6, we determine the tax payable on the current lump sum benefit. That is, we will bring the value in block 3 of 465,750, then less value in block 5 of 371,700, then tax payable on current lump sum benefits of 94,050. Our final comment there, if the member has not elected to take a lump sum withdrawal benefit prior to retirement, that is 250,000 plus 1,250,000, and on retirement received a lump sum benefits equal to 2,050,000, that is 250 plus 1,250,000 plus 1,955,000, we less that 1,405,000. Tax on 2,050,000 will be 143 plus 36% of 2,050,000 minus 1,155,000, which is 895 times 36,000, which is 322,200. If you compare this with the total tax that the member in case study 1 and 2 paid, that is 331,650 plus 94,050, which is 407,700. If now we deduct 407,700 from, if now we deduct 322,200 from 407,700, we get 85,500. We see that the early withdrawals cost the member an additional amount of 85,500 in tax. This does not even consider the loss in opportunity cost. His pension payout will not only suffer from higher tax payment, but more so the loss in growth on the early withdrawals. It is therefore of the utmost importance that members are informed of the far-reaching financial consequences prior to electing to take their withdrawal lump sum benefits in cash. Members must be encouraged to preserve their withdrawal lump sum benefits in either a preservation fund, a retirement annuity fund, or another retirement fund, as it will not attract tax, and the tax-free amount of 550,000 will be available on retirement. I believe so far everyone is clear, but should you have any queries, let us know. You can email us. So scenario 1, when you are given the following scenario, Priscilla Radebe retires with the following amounts: a pension fund amount of 2,265,000, a provident fund amount of 856,000, retirement annuity fund of 1,200,000. She contributed non-tax deductible contributions of 44,000. You need to calculate her current lump sum benefits on the amount she receives from the various funds. Once you have determined the current lump sum benefits, proceed to complete the current lump sum in the table provided to calculate the tax she will need to pay. In your answer, point out the after-tax amount once you have finished calculating the tax she needed to pay. Please take note of the following. The pension only pays out 1/3 in lump sum. The other 2/3 must provide a pension. The provident fund pays out the full amount in cash. The retirement annuity pays out 1/3 in lump sum. The other 2/3 must provide a pension. Therefore, 755,000, that is 2,265,000 divided by 3 plus 856,000 plus 400,000, or which is 1,200,000 divided by 3. It's 2,011,000. The amount of 2 million will therefore be the current taxable lump sum amount, and the 44,000 will be deducted as per paragraph 5 and 6. So number one, our current taxable lump sum benefits will be 2,011,000. We add all retirement lump sum benefits, which we don't have in our case, and then we also add all withdrawals lump sum benefits received on or after, which we also don't have, bringing our total aggregate of all lump sums received to 2,011,000, which is our A. Then two, we subtract deductions as per paragraph 5 and 6 of the second schedule of the Income Tax Act. Our own non-deductible contributions of 44,000. Transfer to pension or provident or preserver or retirement annuity or section 37D divorce, we don't have the amount, it will be zero. Amount transferred to another fund that was taxable, it's also zero as we don't have. Tax unclaimed benefits transferred to preservers, also zero. Transfer to funds from gap parastatal, if formula C applies, less A in formula, it's also zero, bringing our total B of all allowable deductions to 44,000. Therefore, our current taxable lump sum benefits would be A minus B, which is 2,011,000 minus 44,000, which brings it to a total of 1,967,000. Number three, we apply tax table applicable to a current taxable lump sum benefit. Here is the tax table there. And then now we do our calculation. Since 1,967,000, it's higher than 1,155,000 there. Therefore, we use the last part of our tax table on the retirement lump sum benefits, the 143,550 plus 36% of taxable income exceeding 1,155,000. Therefore, it will be 1,967,000 minus 1,155,000, which is 812. That 812 we multiplied by 36,000, giving us a total of 292,320. And it doesn't end there. Remember that 292,320,000, we have to add that 143,550, giving us the total of 435,870. Then number four, we reduction of tax, we add together and then apply the tax table. We add all retirement lump sum benefits received on or after 1st of October 2007, don't have, and then we add also all withdrawal lump sum benefits received on or after 1st March 2009, which we don't have, and then our aggregate of all lump sum received prior to a current taxable lump sum benefits is zero. Then there is a retirement lump sum benefits tax table. So number 5, our calculation, we don't have. And then number 6, determine the tax payable on the current lump sum benefits. We take the value in block 3, which is 435,870. We less value in block 5, which is 0. And the tax payable on current lump sum benefits is 435,870. Let's look at case study number 3. I hope with the previous examples, we are still following, we are still together. But should there be any queries or questions, don't hesitate to contact us. So let's look at case study 3 now. Complete the following case study by applying the applicable tax rates. Kweketso Malema retires from a pension fund on 1st of March 2023, that is the 2023 to 2024 tax year, and his lump sums commutation is 2,275,000. A total of 110,000 of his contributions to his pension fund did not qualify for deduction under Section 11K. Kweketso previously retired from a retirement annuity on 31st August 2015, that is the 2015-2016 tax year. He received a lump sum of 900,000 from the retirement annuity in August 2015. An amount of 35,000 of his contributions to that retirement annuity did not qualify for deduction under Section 11N. Calculate the tax liability on the current lump sum as well as the current tax lump sum that Koketso will receive. So in this case study, you first have to complete the following by applying the applicable tax rate. If the amount excluded, if received before these dates, retirement benefits, withdrawal benefits, the dates below there, and then you apply retirement rate table for retirement benefits and retirement benefits for 1st March 2015, 1st March 2023, the amounts are there. So number one, we find the current taxable lump sum benefit, which is 2,275,000. To that, we add all retirement lump sum benefits received on or after 1st of October 2007, which is the retirement annuity payout on the 31st of August 2015 of 900,000. To that, we also add withdrawal lump sum benefits received on or after 1st of March 2009, which we don't have. So our total aggregate of all lump sums received is 3,175,000, which is our A total. And 2, we less deductions according to paragraph 5 and 6, second schedule of Income Tax Act, on non-deductible contributions of 145,000. Then we transfer to pension or provident or preserve or retirement annuity. We do not have any figure. Amount transferred to another fund that was taxable, it's also 0. Taxed unclaimed benefits transferred to preserver, 0 as well. Transfer to fund from gap parastatal, if formula C applies, less A in formula, it's also 0. And then this brings our total of all allowable deduction to 145,000. Therefore, our current taxable lump sum benefits, which is A minus B, it's 3,030,000. Number 3, we apply tax table applicable to a current taxable lump sum benefit, which will be 3,030,000 minus 1,155,000, which is 1,875,000 multiplied by 36%, which is 675. And the 675, we add the 143,550, bringing the total to 818,550,000. Number 4, reduction of tax aggregate. We add together and then apply the tax table. We add all retirement lump sum benefit received on or after 1st of October 2007, the retirement annuity payout of on 31st of August 2009 of 900,000. And then we add all withdrawal lump sum benefits received on or after 1st of March 2009, excluding current withdrawals, which we don't have any amount. Therefore, our aggregate of all lump sums received prior to a current taxable lump sum benefit is 900,000. Then we use the retirement lump sum benefits tax table, which is there, and then we calculate the 900 minus 770, which is 130,000 plus 27%. Times 27%, which is 35,100. Then the 35,100, we also add to it 39,600, which will bring the total to 74,700. Then number 6, we determine the tax payable on the current lump sum benefit, which we take the value in block 3 of 818,550, then we less value in block 5 of 74,700, bringing the total on current lump sum benefits to 743,850. Therefore, after tax lump sum is that Koketso receives in his pocket now is 2,275,000 minus 743,850, which is 1,531,150. I hope we are all clear now. So there is question 1. Explain the tax deductibility of the employer's contribution towards an approved pension or provident fund. Contributions to pension, provident, and retirement annuity funds. With effect from 1st of March 2016, the tax deduction for contributions made to pension funds, provident funds, and retirement annuity funds is significantly amended. From 1st March 2016 onwards, the tax deductible calculation for the three different funds, pension, provident, and retirement annuity funds, will be identical. The deductions will be limited to 350 per year or 27.5 of the greater of taxable income, excluding any lump sum benefits or severance benefits, but before the donations deduction, or remuneration, excluding any lump sum benefits or severance payments. You take the greater between those two. Excess contributions not allowed as deductions are carried forward to the following year of assessment. Contributions made by employers on behalf of employees would be a taxable fringe benefit in the hands of the employees, but will also be regarded as a contribution made by the employee, therefore deductible in the hands of the employee, subject to the above limitation. Question 1. Mercy resigned from Angels Incorporation. After working for Angels for 16 years, she transferred her pension fund worth 1.9 million to a preservation pension fund, where her funds remained for a further 14 years. The value of the fund at retirement is now 3,600,000 full amount. Calculate the tax payable of her lump sum, as well as the after tax lump sum that Macy received 1st March 2023. The taxable portion of lump sum benefits is determined by using accepted methods. You excluded if received before these dates: retirement benefits, withdrawal benefits, or retirement benefits before 1st of October 2007, withdrawal benefits before 1st March 2009, and you apply retirement rate table for retirement benefits from 1st of August 2015, retirement benefits also from 1st March 2023 of 1,200,000. So number 1, we calculate current taxable lump sum of 1,200,000. We add all retirement lump sum benefits received on or after, which we don't have a figure, 0, and then we add all withdrawal lump sum benefits received on or after 1st March, which also is 0. Then that brings our total A, which is total aggregate of all lump sums received, to 1,200,000. Number 2, we subtract deductions per paragraph 5 and 6 of second schedule of Income Tax Act. We don't have any of those deductions. Therefore, our total of all allowable deductions is 0. Then the current taxable lump sum benefit would be A minus B, which is 1,200,000 minus 0, which is 1,200,000. Number 3, we apply the tax table applicable to a current taxable lump sum benefits as per our tax table, which will always be provided. Therefore, we do the calculation there of 143,550 plus 36% of taxable income that exceed 1,155,000. So 1,200,000 minus 1,155,000 is 16,200. 16,200. It's 45,000. Then 45,000 we multiplied by 36%, which is 16,200. Then that 16,200 we add it to the 143,550, which is equal to 159,750. Then number 4, reduction of tax aggregate. We add together and then apply the tax table. We add all retirement lump sum benefits received on or after 1st of October 2007, and we also don't have it's zero the amount, and then we add all withdrawal lump sum benefits received on or after 1st of March 2009, which is also zero. Then the aggregate lump sum of all the aggregate of all lump sums received prior to a current taxable lump sum benefit is also zero. And then we add all retirement lump sum benefits received on or after, which is zero. Then we use the retirement lump sum benefits tax table given there. For 5, we do the calculation. It is not there. Then 6, we determine the tax payable on the current lump sum benefit. The value in block 3, we take it. It is 159,750 less the value in block 5, which we don't have currently, which is 0. And then the tax payable on current lump sum benefit is 159,750. After tax lump sum will be 1,200,000 minus 159,750, which is 1,040,250. Question 2. Clarice retires from her preservation pension fund at the age of 65, and the value of the fund was 3.9 million, 3/5 at that time. Clarice had worked for her company for 30 years and had been a member of the Preservation Fund for a further 15 years. Calculate the tax payable on her lump sum as well as the after-tax lump sum that Clarice will receive. Number 1. Current taxable lump sum benefit is 1,300,000. You don't have anything to add to that, as there are no retirement lump sum benefits received or withdrawal lump sum benefits received. Then number 2, we subtract deductions per paragraph 5 and 6 of the second schedule, which we do not have. Therefore, our current taxable lump sum benefits will be A minus B, which is 1,300,000 minus 0, bringing the total to 1,300,000. Then we apply tax table applicable to a current taxable lump sum benefits. We will use the last bracket there of, since 1,300,000 it's above 1,155,000. Therefore, we say 1,300,000 minus 1,155,000, it's 250,000 multiplied by 36,000, which is 52,200. Therefore, that 52,200, we add the 143,550, bringing us to a total of 195,750. And then number 4, reduction of tax aggregate. That is where we add together and then apply the table. We add all retirement lump sum benefits received on or after 1st of October. We don't have the figure, 0. And then we add all withdrawal lump sum benefits received on or after, which is also 0. And then our aggregate of all lump sum received to a current taxable lump sum benefit is 0. All retirement lump sum benefits received on or after 1st of October, excluding, it's also 0. Then we use the retirement lump sum benefits tax table there. Number 5, we don't have the figure there. And then number 6, we determine the tax payable on the current lump sum benefits, which is the value in block 3 of 195,750. There's the value in block 5 of 0. And then the tax payable on current lump sum benefits is 195,750. Then the after-tax lump sum, 1,300,000 minus 195,750 is 1,104,250. Activity 1. Explain the difference in the tax regulation between a pension fund, provident fund, pension preservation fund, provident preservation fund, and a retirement annuity. So deductions, contributions to retirement funds. A single and comprising provision section 11K permits a deduction from income for amounts contributed by a member to a pension fund, provident fund, or retirement annuity fund in terms of the rules of that fund. There is a limit, though, to the amount that may be deducted for contributions made by specified persons to any one or more of the funds. The total deduction may not in any year of assessment exceed the lesser of 350,000. This amount is not subject to apportionment or 27.5% of the higher of the members' remuneration or taxable income. That remuneration, it excludes any retirement fund lump sum benefits, retirement fund lump sum withdrawal benefits, or severance benefit as defined in paragraph 1 of the fourth schedule 33A. And B, taxable income, which excludes any retirement fund lump sum benefits, retirement fund lump sum withdrawal benefit, and severance benefit as determined before allowing any deduction under subsection 11K and 18A of donations to public benefit organization and certain institutions, board of directors and agencies. See section 8.40. Proviso 1 to section 11K note that the limit of 27.5% includes contributions made by an employer on an employee's behalf, which amount is included as part of the employee's remuneration for normal tax purposes in the form of a fringe benefit. Any excess contribution disallowed during previous years of assessment solely by reason of the fact that they exceed the amount of the allowable deduction or the unclaimed balance are rolled over and treated as a contribution in the succeeding year and so on, except to the extent that the amount so contributed has been allowed as a deduction against income in any year of assessment, accounted for under paragraph 5, subsection A of subsection A, subsection 1 of subsection A, or paragraph 6, 1B1 of the second schedule. These provisions effectively allow for the deduction from otherwise taxable lump sum benefits of previously disallowed contributions on the retirement, death, withdrawal, or resignation of the member of the winding up of the fund. See section 4.6, or exempted under section 10C in the payment of a compulsory annuity, to which see section 4.6, provided it has not otherwise been deducted, considered in the taxable amount of a lump sum benefit under the second schedule, or exempted under section 10C, proviso 2 to section 11K. Deductions, contribution to retirement funds, we are still continuing with them. Contributions to a recognized provident or benefit fund made on or before the last day of February 2016 were not allowed as a deduction against income and can therefore not be said to have been disallowed solely by reason of the fact that they exceed the amount of the deduction allowable in respect of that year of assessment. Such contributions may not be considered as disallowed excess contributions as part of the unclaimed balance for the 2017 year of assessment. Any provident fund contributions made during the 2017 year of assessment and unclaimed at the end of that year, however, qualify as forming part of the disallowed excess contributions for the 2018 year of assessment. The limits imposed by Proviso 1 to Section 11K must be determined and deducted only after the income amount has been calculated as set out in the orderly computation in the calculation of taxable income. It is therefore determined after the application of paragraph 5.1a of the second schedule because paragraph 5 is considered when the amount to be included in gross income is calculated, and section 10C as it provides for exempt income. The practical implication for the 2017 year of assessment is therefore that the sum of any unclaimed contribution on 29 February 2016 is firstly applied against any lump sum received during the 2017 year of assessment in terms of the dictates of paras 5 and 6 of the second schedule, and secondly claimed as an exemption in terms of section 10C against compulsory annuities if any, and finally deemed to be contributed during the current year of assessment in terms of proviso 2 to section 11K. The final excess is effectively added to the current contributions made during the 2017 year of assessment before the deduction under proviso 1 to section 11K for the 2017 year of assessment is calculated. Contributions by an employer and tax as a fringe benefit in the employee's hands are treated as having been contributed by the member. More formally stated, amounts so contributed by an employer must be deferred to be equal to the amount of the cash equivalent of the value of the benefits contemplated in paragraph 2.1 of the 7th schedule determined in accordance with paragraph 12D of that schedule and to have been contributed by the person. Proviso 3 to section 11K. Employers are entitled, effective as from 1st March 2016, to a deduction in respect of contribution to any pension fund, provident fund, or retirement annuity fund on behalf of an employee, former employees, and the dependent of any deceased employee by virtue of section 11I. The deduction is aligned with the value of the employer contribution fringe benefits value in accordance with paragraph 12D of the 7th schedule. The contributions are included as taxable fringe benefits in the hands of the employee under para 2.1I and 12D of the 7th schedule and are deemed to be made by the employee. The information will be pre-populated on the ITR 12 from the IRP 5 submitted by the employee. Where an employee earns no other income, its remuneration will be used as to calculate the deduction. A partner in a partnership will be deemed to be an employee of the partnership, and a partnership must be deemed to be the employer of the partners in that particular partnership. Proviso 6 to section 11K. Any deductions under section 11K must apply for the purpose of determining the total amount of taxable income before any deduction in terms of section 18A or the inclusion of any taxable capital gain, whether derived from the carrying on of any trade or otherwise. Proviso 5 to section 11K. Item B in Proviso 1 to section 11K establishes an orderly rule for calculating the allowable deductions in the determination of taxable income such that the 11K deduction is determined prior to the allowable deduction under section 18A. It refers to taxable income excluding any retirement fund lump sum benefit, retirement fund lump sum withdrawal benefit, and severance benefit as determined before allowing any deduction under section 11K and section 18A. It thus lays down the methodology for the purposes of the deductions only, while Proviso 5 specifies the methodology for the entire definition of taxable income in section 1. Both Proviso 1 to section 11K and the deduction in section 18A are expressly excluded from taxable income for the purposes of the section 11K deduction. The effective consequences is that the section 18A deduction does not reduce the amount of taxable income taken into account for the purposes of the section 11K deductions. No mention is made of capital gains, which seems to indicate that such gains must be included in taxable income for the purposes of the section 11K deduction, being amounts included in taxable income as prescribed by section 26A. This means that any taxable capital gain must be added to the taxable income as set out in section 10.1 in order to calculate the amount of the taxable income in respect of which the 27.5% limit for the purposes of the Section 11K deduction is calculated. Proviso 5 requires that any Section 11K deduction must apply for the purposes of determining the total amount of taxable income, presumably the final taxable income and not the taxable income for the purposes of Section 11K deduction before the deduction in terms of Section 18A or the inclusion of any taxable capital gain. This would appear to support the submission that Section 18A is the only deduction after the Section 11K deduction, and the sequence in the computational framework in 10.1 from subtotal 3 to the final taxable income is correct. I hope we are still together. Then there is the important question regarding Proviso 5, more specifically, the reason for ordering the Proviso 1 deduction before the inclusion of any capital gain. That is to say, moving it from second last to third last in the computational framework. If the taxable capital gain must be included in taxable income for the purposes of Section 11K deduction, it is also not a sensible approach to provide in Section 11K for the ordering of the final taxable income instead of in the definition of taxable income in Section 1. Proviso 5 refers to the total amount of taxable income, whether derived from the carrying on of any trade or otherwise. That is to say, both incomes derived from the carrying on of a trade and derived otherwise and from the carrying on of a trade must be taken into account, but it is not clear whether both streams of income must also be taken into account for the purposes of the Section 11K deductions established by Proviso 1, since Proviso 5 limits itself to the ordering of the definition of taxable income and not also for Proviso 1. And the wording of Section 11K in this regard is awkward and the practical implication may be confusing. Footnotes 33A, remuneration as defined in paragraph 1 of the 4th schedule exclude paragraph C, 50% of any allowance to a holder of public office. See section 20.2 and CA, an allowance or advance for transport expenses. See section 20.2 of that definition. To be included as remuneration is the total amount of any travel allowance. So let's do activity 2. Calculate the lump sum to be used in determining the tax on lump sum payout at retirement if your pension amounts to the following. Pension fund total fund value is 3 million, provident fund total value is 750,000, and retirement annuity total value is 900,000. So for pension fund, it will be 1/3, 3 million, lump sum of 1 million. Provident fund 750, and then retirement annuity 1/3, 900,000, lump sum of 300,000. Total lump sum for tax calculation will be 2,050,000. Please study the information in your workbook and comment in the space. Study the information regards to gross income special inclusion in accordance with the relevant provisions of the Income Tax Act and list at least 10 such provisions with a brief explanation in the space provided. Please do study the information in your workbook and comment in the space provided. That was about specific outcome 1. Now we are moving on to specific outcome 2. I'm believing that we are all ears. Activity 1, the gross income definition in Section 1 of the Income Tax Act makes provision for gross income special inclusions. Make mention of the relevant paragraphs and list 8 special inclusions listed in the Act. The special inclusions in gross income paragraph A to N of the definition of the term gross income in section 1 of the Income Tax Act includes certain amounts in a taxpayer's gross income, even though these amounts may be of a capital nature. It is expressly provided that the scope of the definition of the term gross income is not limited in any way by the inclusion of these amounts. Therefore, items that are not specifically included under paragraph A to N may nevertheless still fall within the definition. The item specifically provided in paragraph A to N comprises of paragraph of the definition of gross income in section 1 of the Income Tax Act. A. Examples of some of the specific inclusions in gross income will be annuities, including living annuities, alimony and maintenance receipts. These amounts are, however, exempt from tax in terms of section 10 IU, subsection U. C. Amounts received for services rendered. CA. Restraint of trades. D. Lump sums received and accrued because of loss, termination, on variation of employment or office. E. Lump sums from pension, provident, or retirement annuity as determined in terms of the second schedule. E. Paragraph pension and provident fund surpluses. F. Amounts received in commutation of amounts due under any contract of employment or service. I. The amount of any fringe benefit as determined in terms of the 7th schedule. K. Dividends received. However, most dividends are exempt from tax in terms of section 10 IK. Amount received from key person insurance policies and recoupment of amounts that were previously allowed as tax deduction. As already mentioned, these items must be included in gross income, whether they are receipts or accruals of capital nature. Please take note of that. Exemptions. Exemptions are listed in section 10 of the Income Tax Act. If an amount is exempt, it cannot fall into a taxpayer's taxable income and the amount will be free of tax. That is, it is excluded. The exemptions are important since if a taxpayer receives an amount that is exempt in terms of section 10, that amount is free of tax. Some amounts are completely exempt from tax. For example, dividends received from South African companies are completely exempt from income tax, whereas some amounts are only partially exempt from tax. For example, interest received by a taxpayer. There are many exemptions in Section 10 of the Act. Some examples of the exemptions allowed by the Income Tax Act are listed in Table H below and discussed thereafter. South African Financial Planning Handbook 2023 is the exemptions. Exemptions is interest earned by South African resident. The nature of exemption. There is a partial exemption in respect of interest. That is up to a maximum amount depending on the age of the taxpayer. The table immediately below this table sets out the interest exemptions allowed in terms of section 10I1. Amount received or accrued in respect of tax-free investment, section 12T. Any amount received from a tax-free investment is exempt from income tax and capital gains tax. To qualify, the investment must be owned by a natural person and the investment must be a financial instrument or policy that is administered by a person or entity designated by the Minister of Finance. Contributions must be made in cash. Section 12T defines what is meant by a tax-free investment. A taxpayer can contribute up to 36,000 every year with a lifetime contribution limit of 500,000. The return from this tax-free investment are exempt from both income tax and dividends tax. Certain institutions such as banks and long-term insurance collective investment scheme companies are permitted to offer this tax-free investment product to taxpayers, whereas the annual or lifetime limits are exceeded, a penalty of 40% of the excess contribution is imposed. Interest earned by non-resident. exempt from normal tax. Section 10 IH section 10(1)(h), but certain interest is subject to a 15% withholding tax, but also subject to the relevant terms of any double tax agreement. The nature of exemption: interest earned by a non-resident is exempt from South African tax, provided A, that the individual is physically absent from South Africa for at least 183 days, and B, did not carry on business in South Africa through a permanent establishment during the tax year. Certain interest from a South African source to a non-resident will be subject to 15% withholding tax on payment. Section 37J. Any non-resident who does not qualify for the interest exemption as described above will not be subject to withholding tax, but will have to include such interest in income for normal tax purposes. So far, so clear. So the final withholding tax of 15% will not apply to the following interest: payable by any sphere of the South African government, interest arising on any listed debt instrument, arising on any debt owed by a bank, the DBSA, the IDC, or the SARB. Interest arising from a bill of exchange or letter of credit where goods are imported into South Africa and where an authorized dealer has certified such on the instrument. Interest payable by a headquarter company where transfer pricing does not apply. Interest accruing to a non-resident natural person who was physically present in South Africa for a period exceeding 183 in aggregate during that year, carried on business through a permanent establishment in South Africa, payable by a local stockbroker to a non-resident. The following interest will therefore be subject to withholding tax, subject to any double tax agreement: interest on Eskom stocks, interest on a loan to a South African resident, shareholders' loan to South African companies. Exemption: dividends from South African companies and distributions from close corporations. Section 10(1)(k). Nature of exemption: dividends from South African companies are usually 100% exempt in the hands of a taxpayer. Dividends from South African companies are completely tax-free in the hands of the shareholders or members, and dividends from JSE dual-listed non-resident companies are likewise exempt. Any dividend that is paid to a person for services rendered by virtue of employment or by virtue of holding an office will not be exempt from income tax, and the dividend is treated as normal income. Such a dividend, being regarded as normal income, will not be subject to dividends tax. Again, foreign dividends from foreign companies. A foreign dividend is an amount paid by a foreign company in respect of a share in that foreign company. A foreign company is any company that is not a South African resident. Some foreign dividends are completely exempt from tax in South Africa. However, if the applicable exemptions do not apply, foreign dividends are partially exempt in terms of a formula whereby the maximum effective rate is 20%. Therefore, most foreign dividends received by individuals where the shareholding is less than 10% in the foreign company are taxable at a maximum effective rate of 20%. These dividends are taxed in terms of the normal tax system, not dividends tax. Foreign dividends are discussed in more detail below this table, section 10b. Bona fide scholarships and bursaries to enable any person to study at a recognized educational or research institutions are exempt from tax. That is section 10(1)(q). The nature of exemption is that 100% exemption of the bona fide scholarship or bursary, but there are certain restrictions in respect of scholarships and bursaries awarded to employees and to relatives of employees. Government and provincial receipts and accruals are exempt 100%. The receipts and accruals of approved public benefit organization are exempt from tax, 100% exemption, say according to section 10(1)(cn). The receipts of The receipts or accrual of entities that provide funding to SMMEs are exempt from tax. Section 30C as of 1st April 2050. Entities that are engaged in activities that support SMMEs, such as funding, business support, and training, can apply to SARS for their receipts and accruals to be exempt from tax. This tax relief is therefore similar to the tax relief given to public benefits organizations. Alimony and maintenance receipts are exempt from tax. Any alimony or maintenance receipts arising from divorce or separation are exempt from tax in the hands of the receiver, in the hands of the recipient spouse if the divorce or separation proceeding took place after 21st March 1962. Micro business receipts and accruals are exempt from tax. Section 10(1) ZJ. If a micro business elects to be taxed on taxable turnover, then its receipts and accruals are exempt. This section ensures that there is no double taxation. Receipts and accruals of pension, benefit, provident, and retirement annuity funds are 100% exempt. Voluntary purchased annuity, the capital portion is exempt, calculated according to a formula. This is discussed in more details below. Employer paid compensation awards. Compensation award paid by an employer on the death of an employee in the course of employment are exempt up to an amount of 300,000. Lump sums on termination of employment are exempt. Any severance payment from an employer for reasons of age, ill health, and retrenchment is aligned with the taxation of retirement lump sum benefits, and this lump sum may qualify as a severance benefit, which is subject to their own rates of tax. Interest earned by South African resident is exempt from tax up to a certain amount. Remember, I told you that previously. So here is the look at which certain amounts are those. Tax year ended February 2012 to 2013. Amount exempt for taxpayers below the age of 65 was 22,800. But for the tax year 2013 to 2014 to 2023, the amount is 23,800. So amount exempt for taxpayers who are older than 65. During the 2012 and 2013 year end, it was 33,000. But up to now, out from 2013 to 2023, it's 34,500. So summary and example, exemption of dividends and interest. Dividends from South African companies are 100% exempt from tax in South Africa. South African interest, which is earned by a person who is younger than 65 with a maximum amount of 23,800 is exempt from tax. South African interest, which is earned by a person who is 65 or older, maximum amount of 34,500 is exempt from tax. Let's look at this example on interest exemption. Mr. X, who is 42 years old, received SA dividends of 19,000, the foreign interest of 3,800, SA interest of 20,000. What is his income for tax purposes? The solution, gross income, will be all the SA dividends of 19,000, the foreign interest of 3,800, and SA interest. And then less the exemptions. South African dividends are exempt in full, remember, provided that they are not received for services rendered. So that is why we are having those SA 19,000 deducted. South African interest is exempt up to a maximum of 23,800 income. And in this case, since it is 20,000, all of the 20,000 will be exempted, and then we will have income of 3,800. I hope this is very clear. Foreign dividends, Section 10B. Section 10B of the Income Tax Act provides that certain foreign dividends are exempt from tax in South Africa. Briefly stated, the following exemptions are available. If the person received the foreign dividends, if the person receiving the foreign dividends holds at least 10% of the total equity shares and voting rights in the foreign company, the foreign dividends is exempt from tax in South Africa. 2. If the foreign dividend is received by a foreign company which is resident in the same country as the foreign company paying the dividend is exempted. 3. If a South African resident receives a foreign dividend, it will be exempted to the extent that the foreign dividends does not exceed the total amount of all amounts that are included in the resident's income in terms of Section 9D. Section 9D deals with controlled foreign companies. This exemption ensures that the same amounts are not taxed twice. 4. If a foreign dividend is not a dividend in specie and is received by a resident in respect of a JSE listed share, it will be exempt because it has already been subject to dividends tax. To the extent that a foreign dividend is not exempt in terms of 1 to 4 above, it may be exempt in terms of a so-called ratio exemption. This exemption is calculated as follows. A, if the person receiving the dividends is a natural person, deceased estate, insolvent estate, or trust, the calculation is as follows. An amount of exemption is 25/45 times total foreign dividends for the tax year that were not otherwise exempt. B, if the person receiving the dividend is a company or person not falling under A above, or an insurer in respect of its company policy fund, corporate fund, and risk policy fund, the calculation is as follows. Amount of exemption is 8 divided by 28 times total foreign dividends for the tax year that were not otherwise exempt. If the person receiving, that is C, if the person receiving the dividend is an insurer in respect of its individual policy fund, the calculation is as follows. Amount of exemption is 10 divided by 30 times total foreign dividends for the tax year that were not otherwise exempt. Question 1. List at least 5 benefits that your clients will enjoy when belonging to a pension fund at the employer. Retirement benefit, the member will receive the equitable share, net contribution plus interest in the fund as a lump sum or a portion or the full value paid by means of a monthly pension. Resignation benefit, the member is entitled to the equitable share in the fund, net contribution plus interest, and this benefit can be taken in cash or it can be transferred to a preservation provident fund or retirement annuity. Death benefit, in the event of death before retirement, the member's dependents and or beneficiaries will receive a cash benefit which consists of the death cover offered by the chosen plan as well as the equitable share in the fund, net contributions plus interest. Funeral benefit, in the event of the death of a member's spouse or child under the age of 21, a funeral benefit will be payable to the member according to the applicable portion of the fund. War and riot exclusions. There are a war and riot exclusion terms and conditions may vary from time to time. Communication, every member will receive an annual benefit statement which will reflect the member's equitable share in the fund and the cover for death, disability, and family funeral benefits under the associated separate group scheme. I hope you were able to list any of those benefits there. We have come to the end and thank you very much. If you have any questions, kindly contact us. Thank you.